Hey traders, welcome to the Strategy Lab video. If you guys are new, my name is Alexander Nikitin. I am a professional trader and a developer of MPS software. In today's video, I want to talk about the pattern trading for scalping, for 5-minute trading. Okay, the pair that I'm going to use is euro-dollar, and the time frame is 5 minutes. And let us start. First of all, let me set my MPS software. I will go to indicators, I will go to this, and I will enable the stop loss that I need. Okay, and then I need to enable the patterns that I want to use. Okay, the strategy is very simple. Let me call it 10-6 strategy. Okay, why it is 10-6? First, it is 10 pips for your stop loss, and it is 6 pips for your take profits, regardless of the pattern size, regardless of anything else. Okay, what you need to do, go to the history. Let me go somewhere into some history. And let us start from this. Let's zoom it in. So we have a potential pattern here. It is this one, yes. So the pattern should complete. It means that it should enter this reversal zone. And you can see this indicator shows that the movement is choppy, so you need to skip this pattern. So you go slowly to the future. Okay, now here it is. Here is the pattern. So the pattern should complete, yes, the movement should be straight to the upside. At least it should be shown by your indicator that it is straight. If you use some other methods of swing identification and it tells you that it is not straight, then it is not straight. Okay, after the pattern is completed, yes, so what you need to do, you need to place a stop order. If you don't know what is the stop order, it is a kind of pending order that for sell it is lower than current price, and for buys it is higher than current price. So it is called a stop order. Do not mix this notion with stop loss order. Of course, the type of the order is the same. It is called stop, because we place our stop loss order if price goes higher. It is a pending order for a broker to be executed, and the stop order works and it limits our loss. That's why it is called a stop loss order. But if you are not in this trade yet, you can place a stop order, and of course it won't be a stop loss order because you don't have any position. Okay, this is the stop order. It means that you need to place your stop order 1 pip away from your last candle low. Okay, so here we have this candle low. Let me zoom it in. This candle low, it triggered the pattern, this one. So we need to draw 1 pip. We have a 5-digit broker. This means we should ignore the 5th decimal, yes, and the pip is the number 4 after the comma, yes, after the dot. So 1 pip looks this way. It is drawn as 10. So you calculate 1 pip. So this one is your stop order, like this. Immediately when you place your stop order, you also place a take profit and a stop loss. So your stop loss should be initially 10 pips above this. So 10 pips, let me calculate this, 10 pips here. It is 1836.5. 1836.5. 36.5. Okay, then your target should be 6 pips. Let me place it here. 6 pips. It is 1820 and 5. 18, 20 and 5. 21, 20, and 5. So as you see, the target is always fixed. Well, when the pattern is completed, it is called a setup. It is called a signal candle, yes? And when the next candle executes your stop order, it is called an entry candle, yes? Based on my rules, you should do the following. You should, after this entry candle closes, you should move your stop loss to your to the highest between the signal and your entry, to the highest point between the signal and the entry. Right now it exceeds 10 pip stop loss in this situation. That's why we just leave it 10 pips. Well, I hope you understand this. But if it were slightly less, the stop loss would be this. Yes, if it were here, for example. If it were here, it would be limited. After the candle closes, the entry candle, the one that triggers your entry, immediately after it closes, you move your stop loss to cut your potential losses. So sometimes the stop loss is dynamic, and sometimes it is 7 pips, 5 pips, 6 pips, 2 pips. You can reduce it to even smaller, to 1 pip, and so on and so forth. So this is needed to cut your losses. And overall, moving that stop loss close to your entry it gives you a good risk to reward in future. But when you place your entry and it is still a pending order, it should be 10 pips initially, 10 pips and 6 pips target. After this candle closes, then you move your stop loss to other levels. Okay, let me zoom it in. Let me go here. Let me find some more example here. So you see the patterns are calculated real time. Here it is. Here's the pattern like this. So I don't talk about this one. It didn't complete. It never hit the level. Here's the pattern. So the next situation. Okay, the pattern completed here, yes? So you calculate your 1 pip this way. 1 pip. Of course, you can calculate it something different. So you place it 1 pip above your signal candle, above your completion candle. Of course, if you are not triggered on the next candle, you can place it on next, and lower and lower and lower, all the way to the downside until the pattern is invalidated, and the invalidation level is this, like this. You see, if you never hit that order, you simply delete this order when it is invalidated. Initially, yes, when you set your pending order, this is your entry, your stop loss goes here, 10 pips, 77, 73, yes, and your take profit goes here, 6 pips. It goes here. Hey, come on. 77.89. 77.89. Your take profit goes here, and immediately after this candle closes, the entry candle should close. The entry means when it triggers your entry. When it closes, you do the following: you limit your losses, moving your stop loss just at the low of this candle, at the low of lowest between the two. If the signal candle is lower, then it should be the signal candle, below the signal candle. Yes. If this candle is lower, then it should be this. Maybe sometimes this candle is lower, yes, and sometimes you move it here to this candle. Which one is lower? So simply to mark that lowest low here, it should be the extreme low. And this way you limit your loss, and you see, in case price reverses, you will hit 4 pips stop loss versus 6 take profit. So you limit it immediately after the entry candle closes, but until it closes you don't do anything. Sometimes you have it this way: you enter it because it spiked through your entry, and then it reverses, it goes all the way down to hit your 10 pip stop loss. Sometimes, very rare situation, but it happens. I found 3 of them in a series of 400 trades. 3 of these situations were met, and it happens. Okay, now let's consider next example. This one is not okay because the choppy movement here. This one is pretty good, but let us see if it was not invalidated. So let us zoom at this pattern. So this was a signal candle, yes, starting this one, signal candle. So we didn't have next candle moving lower than this signal candle. So this one is a signal candle next. Yes, this candle moved below the low of this candle, and let's calculate if the movement was enough to initiate the trade. And if you will see here, it was not enough. So stay away of this. So this candle, no trade, no trade, no trade, and the next candle moves beyond the pattern limits. So no valid, nothing here, nothing here. So slightly move from one pattern to another and calculate them until you find those patterns that are good. So same here, no valid pattern, same here, no valid pattern, and right now we have a pattern that seems valid to me. So it was this, yes. Let me draw this level. One pip, yes. So this is the candle that completes. It is the signal candle. Next candle didn't hit the entry. Let's go next candle. It did hit the entry. You need to move it next candle, so it should violate the adjacent candle low. You can see this and this. So get involved into here. Stop loss is 10 pips above. It means 1589. 1589. Oh, 1598, sorry. And take profit below 6 pips. It goes 1583. 83. After this candle closes and we see it closed, we place our stop loss just at the top of that. So if it was a signal candle, then it should be at signal candle. If it was somewhere earlier before that, then it should be earlier at the top of this. So this way the loss is cut to 4.4. 4.4 versus 6. Okay, and you simply wait until this is hit. You see, initially 10 pips, but then it is limited to whatever market says. Let me put it this way, to whatever market says. Okay, now let's go to results to see how it goes. So the results say this. It is a chart. Here it is. So you can find, so I found 400 samples on 5 minutes. Trades, 400 trades on 5 minutes. They are both unified Gartley and a cipher pattern, so maybe 200 for each of them if I split them by half. I didn't split them as different, so if it is a cipher, then it is also traded this way. Okay, And you see the stop loss sometimes 4 pips, 5 pips, 6 pips, 7, sometimes 2 pips. It happens also when the candle was very small. So it is dynamic, and the take profit is always 6 pips. Well, so I also did this calculation of spread. So let me disable this spread, and now I will show you the impact that it has. I saw many traders do the back testing, and they see, you know what, my strategy, look how it works, and you see this, yes. And when they start trading on 5-minute time frame, and the spread for 5-minute time frame, let's say not euro dollar, but if you take something euro and New Zealand, it will be 6 pip spread, yes. So what is the result then? The result is absolutely negative, simply because of this fact. So you should first find the pair that is profitable for 5-minute trading, and I did it this way. I compared the average candle range, average true range of the candle, and the spread, and if it is the spread is 20% or more of the average candle range, then the pair is not good for 5-minute trading. So on euro dollar 5-minute, the average range of a candle is somewhere 3.6 pips, and my average spread with euro dollar is 0.6. So if we divide them to 3.6 by 0.6, we will have 6. So it means that my average candle range is 6 times larger than my spread, and of course it is less. My spread is less than 20% of an average range. So I have some space. I'm not paying too much to my broker. Okay, so this is the strategy. As for numbers, yes, using my spread, I don't know what is yours. Maybe yours is 1. So you will have the expectancy slightly positive, but it still wins. If we have 1.2, then it would be not valid for you. So find a broker, preferably an ECN broker. Not all the brokers are good for scalping. And ECN brokers provide you the tightest spreads, as I have. For example, 0.6 is my spread. But if you have 1, it will still be profitable. Not as profitable as this one, but still it moves to the upside. Okay, it's not this chart. With a maximal drawdown of 69 pips and 0.6, what I have with my broker, it moves this way, and the maximal drawdown is 61 pip. Okay, so here are the results. 250 pips generated. So if you divide that 250 pips by 60 pips maximal drawdown that was met during this period, the recovery factor is more than 4. It is 4.1, 4 point something. 250 divided 60. The recovery factor, it shows how fast the strategy recovers after a drawdown. So it recovers pretty fast. The higher is the recovery factor, the higher is your speed of recovery. I also did some calculation starting from this 10K account, and I also depending on your currency, I typed my currency, so, and I typed a lot. So it is 1 mini lot. This is the currency that I generate, and these are the calculations. So it goes here using 1 mini lot, and if you use 1 mini lot, the money management strategy is very simple. If you double your account, you double your position size. So let's go, when you double it, it is 19, almost 20, and when we double it, it is here 20. So after we hit 20, next we should double this position size. So from here we should type 0.2 and start trading with this increased position size. Then it goes increased, and if we double it to 40, 100, then we will double it one more time. So it is 26, 25, 27, 30, 30, and well, it's at 29. So I need to find some more data, to find some more trades to do this. Okay, here it is, and here's the chart for that money. Of course, it is, well, it was the point when I doubled my position size, and immediately after that the drawdown started. So after I increased the position size, the drawdown started, and it looks ugly. It looks enormously big, and on this drawdown it says that the drawdown was 27% drawdown. Well, I think this position size is too big. Not everybody is able to digest that 27% drawdown. Of course, should start that smaller, maybe go to 5 micro lots or something of this kind. Okay, now that's it. If you want a dollar value, you should type 10 here, and then you go type your position size. So if you want to have a dollar value, the dollar value is this. It is what you generate using one standard lot, and this is your position size. This is the fraction of that lot. If you trade 0.01, it is a mini lot. So 10 multiplied mini lot, you will have it this way. After 400 trades, 10K dollars turned into 1025, so it needs to be increased, I suppose. Well, what is the best for 10K? Generating $5 on each and every case. Of course, the drawdown will be very, very small. It is 0.6% drawdown. So we can increase this by 5, for example, yes. So it should be half lot here. It can be easily increased by 5. The stop loss is maximal stop loss is 10 pips, yes. So if it is 0.5, it means you lose $5 on each and every trade. So it is maximal 50, but you limit your losses very quick, yes, and you never risk too much. Let's go to the chart using the 10K. After the course of 100, you generated 10%, 12% generated. Risking only what was the maximal risk. The maximal risk was 2.85 using fixed position size, 2.85, and it is 12% divided 2.85, and the recovery factor is 6. 12% total divided 2.85. It is 4.2. Okay, it is almost the same as it is here. Okay, well, so while doing your backtesting, don't forget about your spread. Yes, if expectancy says it is negative, simply forget about this strategy, or think about to trade in opposite way. For example, if it is heavily negative, it is minus 0.40 or minus 0. Or minus 2 or 3, heavily negative, think of going opposite direction. If it is somewhere around break even, somewhere around 0, it is 0.0000 something, or it is minus 0.00 something, it will be a negative strategy as well, because your spread will lead to this, your commissions will lead to losing your account. But if it is heavily negative, then you found a strategy that works opposite way. Simply, instead of buy, press sell, instead of sell, press buy, and you will be profitable in a long run, and your expectancy will turn positive. Okay, this is for backtesting purposes. Okay, I remind you the set of rules once again. Wait for a lower low, that is at least 1 pip below the previous low. Initially place your stop order. This is the order that is a pending order that should be executed at the price 1 pip lower for sell and 1 pip higher for buy. And initial take profit is 6, initial stop loss is 10. Immediately after the entry candle closes, you should move your stop loss to cut your losses. That's it. This way you will have this average risk to reward of 0.79 if consider spread, but without spread the net risk to reward is 0.97. So it stays somewhere around 1. Sometimes it was more than 1, sometimes it was less than 1. I think that if I find 100 more trades, another 100 trades, it will become somewhere around 1. Okay, so this is the net risk to reward, but if you consider spread, of course it becomes slightly less. Spread is something that makes your profit smaller by 0.6 and your stop loss larger by 0.6. Well, hope you like this strategy. Hope you do the backtest of it, find your own examples. This is simply scalping strategy. Using fixed take profit size and fixed stop loss size. It is another way of trading these patterns, another approach that also works. So it is no something true way for trading patterns or something of this kind. The pattern is simply indicating a potential movement. And how will you capitalize on that knowledge that this movement is probable, that here you may have a potential reaction or something of that kind, the potential movement? How you will do that? Will you be able to generate money on this fact, or will you not be able to generate money on this fact? This is only up to you. That's why it is not a guarantee if you will use the same software that I use that you will generate the same money as I generate. Okay. Hope you like this video. If so, give me a thumbs up, share this video on social media. If you're interested in my software, you are welcome to visit my website www.ps-software.net. Here it is. You will find a link in description. Watch these videos, introductory and demonstration video. This demonstration video is for MPS version 4, and right now I'm currently using MPS version 5, but MPS version 5 is not yet officially released, but I already started my pre-market sell-off. So if you go to my website and you pay for MPS version 4, the price for MPS version 4, you will get the MPS version 5. And search on my YouTube the MPS version 5 differences. So it is much faster than MPS version 4. It is much it has more algorithms for searching the patterns. It has more patterns and it is it has graphic interface as well. It is much more handy and customer friendly. This time it hits stop loss. So the pattern hits stop loss. Total stop loss is 4.4. It didn't hit this 6 pip target, so you see movement started to the upside. I also can suggest some filter. For example, if you dislike that 60% probability, you can use this filtering. Use some higher time frame, for example 1 hour time frame or something of this kind. And as you know, these patterns better work during range periods. You only should look for range candles. And what are those range candles? They are candles that have very small body, and this body is less than 30% of the total candle range. And so what is the idea? The idea is this: if you have a trend candle to the upside, yes, then most likely you will have this trend continue higher and higher and higher. And if you have a range candle, this kind of an indecision candle, most likely you will have the next candle being a range candle as well, or some candle with a small body as well. So this is kind of confirmation for you. For example, this way the indicator shows it was a trending to the upside day, so we have a bar that trended. And also, if you examine few previous candles, you had a heavily trending day followed by range, and then followed by another trending not day but hour, trending hour. So they three form a kind of flag formation on lower time frame. I bet this is a flag formation on a lower time frame. For example, let me put the start here and let me draw it this way and this way. So this is a flag formation that was broken to the upsides. Just go to 15-minute time frame or whatever and you will see what I'm talking about. Maybe this way. Something like this, flag or wedge formation that was broken to the upside. And it is seen as a micro pattern on 1 hour time frame. Simply trend day followed by range day. It is typically a flag, a wedge, or whatever pattern, and it is a sign of continuation. So if you're familiar to these patterns, you can use them to filter your trades. So maybe you will simply get out of your selling position here, and you will be looking at only buying position, because the trend on 1 hour is to the upside, trending candles to the upside. It is a way to use some filters, higher time frame analysis. Well, now that's it. If you like this video, give me a thumbs up, share this video on social media. If you're interested in my software, click this link in the description, go to my website, post your comments if you have some suggestions. If you have some questions, I will try to answer them. Until then, good luck and good trading. Hope to see you soon.